Hello and welcome back to The Note, still coming to you from New York. Today we're going to be talking about perhaps the most surprising and also the most important market development of the year so far, and that's in the Treasury bond market. Now, at the end of last year, the Fed at last started tapering off its QE bond purchases. The yield on the 10-year hit 3%, and there was really quite a strong consensus what we were going to see next, that we were going to see another half-point move in yields to around about 3.5%. We were right about the half-point move in yields. We were just wrong about the direction. It's now at around 2.5%. A big surprise for all the pundits. With me now to try to explain why they went wrong, what's happening, is our US markets editor, Mike Mackenzie. Mike, thanks very much for joining me today.
Good to be here.
Let's start by taking a look at the remarkable bull market in 10-year treasuries. Still uninterrupted, a trend that's now been going on for over 30 years of bond yields inexorably falling. It seemed such a safe call that we were finally seeing the turn in this. What's happened? Why has that been wrong?
There's been a combination of factors. I think one of the biggest issues is that at the beginning of the year, after last year's 30% rally in the S&P, a lot of pension plans in the US had reached a level where they were now fully funded and decided a 3% 10-year and a 30-year bond close to 4% looked very good to switch out of equities and go into bonds.
So they just snatched the opportunity to get them relatively cheap by recent
standards. And that was the big driver for the first couple of weeks. Then we had the emerging markets concerns with Turkey and then Ukraine. So we saw stocks take a bit of a hit in January into February. And that gave further fuel to the fire. People coming in buying.
Or whatever.
So we had that going on. And since then, though, I think what's really begun to confound people is the fact that the economy, a lot of equity analysts, for example, people who are bullish on the stock market this year are saying, forget about Q1. It's just a write-off. It was a very tough winter. In the bond market, they're coming at it from a different perspective. They're saying, yes, Q1's bad, but it's not just about the weather. It's really bad. And more importantly, while we may get a Q2 rebound, which we kind of saw hints of with the April jobs number that came out at the start of this month, the bond market sold off for about 20 minutes and then promptly rallied all the way back.
No, that was remarkable, wasn't it? Yeah.
Yes, and so the bond market's saying, yes, there'll be a rebound, but ultimately, this economy is not going to get above a 3% annualized rate of growth anytime soon. And that leads us to the next piece of the puzzle, which is now, and we saw this week with PIMCO coming out with what they call the new neutral.
Right.
Effectively, the bond market is doing the math, and it's saying, well, if and when the Federal Reserve does start to raise rates, they may not go to 4% on the Fed funds rate. They'll actually maybe only go to maybe 2%. Which
is still historically incredibly low.
Yes. And that would reflect, of course, the fact the economy won't be growing much beyond 3% rate. And more importantly, you've got this demographic of baby boomers retiring, leaving the jobs market. So the recovery is not going to be the kind of recovery we've seen in past decades. Now, if you've only got a 2% Fed funds rate, or maybe 2.5%, you can actually begin to make an argument that, well, the 10-year yield at 250 and a 30-year bond yield around 340, it all fits together.
So let's take a look at the guts of the yield curve now to see how this plays out for investors' choices. What we're looking at here is the spread of 30-year yields over 5 years. Obviously, a very sharp contraction over the last 5-6 months.
Yes.
What's driven that?
Again, this is the perception in the bond market that the Fed will not allow inflation to get out of control. It's one of the bigger fears. If you are a buyer of long-term bonds, inflation is your biggest enemy. You are relying on a fixed rate return for a very long period of time. You want to have a central bank that is going to be tough on inflation. And because the 2-year yield is very, very close to the current overnight Fed funds rate of between 0 to 25 basis points, the 5-year has now become the barometer of rate hike expectations. And since the start of this year, we've seen the market begin to factor in, rather than rate hikes beginning late 2015, maybe early 2016, they're actually beginning to say it could be a first half of 2015 story. And in fact, today, one of the Fed governors, Bullard, came out and said we think we'll see the first rate hike at the end of Q1 next year.
So if you look at the entrails of the bond market, what we're seeing is rates rising perhaps a little earlier than people expected, but peaking quite a bit lower than people had been expecting.
And the bond trade to do is, I mean, a lot of people look at the bond market and go, well, there's an assumption that people either buy outright bonds on their own, what really animates bond trading and bond markets in general is that a lot of people like to trade different maturities. So trading 5s versus 30s is a classic way to immunize yourself in an environment where the Fed may be starting to raise rates.
Okay, Mike, thank you very much indeed. To sum up, obviously a better world, a safer world for the bond bull market than people had thought. Plainly, more or less everything we've just discussing is roughly as bad for stocks as it's good for bonds.